Hey, what's going on, everybody? It's Kevin Lau here for another Whiteboard Fireside Chat. And today we're going to be addressing the question, what is the 4% rule? Okay, for those of you that don't know, I've talked about this many times on my podcast before, but I've never done a Whiteboard Fireside Chat on this. But the 4% rule was invented by Bill Bengen, and essentially was a study that he did in the 90s back testing rolling 30 periods of portfolio returns and wanted to determine what a safe withdrawal rate would be from an investment portfolio so someone would not run out of money. Okay, because that's probably the number one concern for most of you watching this podcast is, or this YouTube video is, will I run out of money? Okay, and making sure you protect against that risk is probably at the forefront as you prepare for retirement. All right, so if you're in that 55 to 60 range, this could also give you a benchmark in which you start with to say, hey, you know what? How much could I safely withdraw from my portfolio to ensure I protect against longevity, to ensure I protect against inflation? So we're going to dive into this. We're also going to talk about some of the limitations of the 4% rule and some of the weaknesses of the 4% rule. And I don't even like to call it a rule. I like to call it a benchmark, but it is what it is. It's called the 4% rule. And then on the next video I'm going to actually walk you through a live example of a real life client and how they're actually going to implement portfolio withdrawals that may go against the grain of this traditional thinking of the 4% rule. So without further ado, I'm going to jump into the whiteboard. All right, so what is the 4% rule? We've already addressed Bill Bengen. Was a former rocket scientist turned financial planner in the 80s and 90s because he was essentially trying to figure out how much can I withdraw from my portfolio now that I'm retired as a rocket scientist. And he figured that there was, what he learned, there was no research out there that was done to really illustrate what a safe withdrawal rate would be. So he went on this rabbit hole and looked at, okay, let's look at all these rolling periods of historical rates of return. And he determined that the 4% starting withdrawal rate was a safe withdrawal rate. Okay. And so let's actually unpack what that looks like. All right. So let's say we're starting with a client that has $1 million portfolio, and let's say they're age 60. Well, if we started with a 4% rate of withdrawal, okay, so that is 4% of $1 million is $40,000. That would be the amount that this individual could safely withdraw that first year in retirement. Okay, well, what about the next year? Well, let's assume inflation was 3%. Okay, so if they were taking out 40,000 that first year, in year two, when they're 61 years old, okay, then the rate of withdrawal is going to be 41,200. So we had an inflation raise. And so each and every year, the rule states that you can give yourself an inflation raise, whatever inflation might be. And that was the really cool part about this research, was Bill wanted to sort of look at also not only the rates of return historically, but also the associated inflation rates. And essentially what he found that there was no 30-year period. There was never a 30-year period where someone ran out of money. In fact, the worst performing period was a 33-year horizon. That was a worst case scenario for an individual. And I actually thought that this individual was retiring in 1968, but I think it might be actually 1966. And essentially these individuals, regardless if it was 1966 or 1968, retired in two bear markets, and two bear markets occurred within 5 years. And, you may have heard this idea of sequence of return risk. Essentially what that means is you retire at a bad time, and the sequence of returns after retirement causes you to potentially have a shortfall in retirement that you otherwise wouldn't have had if you had normal, maybe more average rates of return or even above average rates of return. So I think it's really important to illustrate the fact that this 4% rule is kind of like the worst case scenario, okay, where, you could safely take out 40,000 the first year, give yourself an inflation raise, let's say it's 3%, and then continue on. And there's never been a period where you ran out of money prior to age 90. All right. That's pretty good. But there may not be your goal may not be to maximize your financial legacy. And the challenge with this 4% rule is that, sure, those address those kind of I'm not going to call them black swan events, but kind of that worst case scenario. Someone retiring in 1966 or retiring in 1968. But what about those other situations? Okay, what about those other types of market? Okay, so this is illustrating Bill Bengen's Safe Max study, and so I'm going to link this in these show notes. And this is one of the illustrations of the figures that really illustrates this whole 4% rule. Okay, so one of the first things I'll point out here is the assumption that Bill had in this study is that an individual would have 50% in stocks, okay, 50% in stocks, and the remainder in in intermediate U.S. Treasuries. Okay, and so if you've been following my podcast or if you've heard me speak about diversification before, you know we're not going to be 50% in stocks and 50% in U.S. Treasuries. We're going to be very well diversified. We're probably going to have, not only large cap U.S. equities, and by the way, that's assuming the S&P 500. We're not only going to have large cap stocks, we're also going to have small cap stocks and international stocks. And then with fixed income, we're not only going to have U.S. Treasuries, we're also going to own corporate bonds, potentially municipal bonds. So we're going to have some more diversification in there. But I just wanted to point that out because, you have to have some assumptions built in. And this was what's built into the 4% rule was a simple allocation of 50% in the S&P 500, 50% in U.S. Treasuries. And what you can see is, I mentioned 1968 here. I'm going to make this a little bit lighter. Okay, 1968 is here. This individual's portfolio still lasted, despite going through those two recessions within 5 years or two bear markets within 5 years. And oh, by the way, hyperinflation in the 70s and 80s, double digit interest rates. This individual's portfolio still lasted over 30 years. Even in 1966, again, I thought it was 1968 was the worst case scenario. It looks like it's 1966 to me, but I might be wrong. If you're watching this and you know the answer, is it 1966 was the worst case scenario or 1968? But either way, as you can see, both of these portfolios lasted beyond 30 years. Okay, I believe the worst case scenario was 33 years the portfolio lasted. But look at these other scenarios. Again, Bill didn't even go past 50 years, but look at these other scenarios. Okay, we've got 50 years here. Most of these individuals that retired in these years, this is 1926, by the way, 1950, 1976, etc. Most of these individuals, their portfolio lasted 50 years. And I'm actually thinking it's probably well beyond 50 years. These portfolios are probably still intact today. Okay, sure, we had a little blip in the radar here, but 1938, we still had very close to 40 years, in that scenario, very close to 40 years here in this scenario. Okay, just over 40 years in this scenario. So my point is, should you go and plan for retirement assuming kind of that worst case scenario? And that's what that 4% rule is. It's really sort of, for all of the worrywarts out there and really just concerned about what is the worst case scenario. Well, if you start with the 4% rate of withdrawal, you could probably just be just fine lasting at least 30 years into retirement, if not longer. Okay. But that's the 4% rule. All right. Now look at this. This is pretty cool. This is another figure from that same SafeMax study by Bill Bengen. And look at this. This actually goes up to 50%. All right. And again, same assumption, 50% in stocks and the remainder in intermediate treasuries. Okay. And look at in these scenarios, even increasing the rate of withdrawal to 5%, we're still in the scenario where your portfolio is going to last at least 20 years. Okay. So if you're retiring at 60, that'll take you to 80. That might be concerning. You may want to still have an investment portfolio in your 80s and 90s to protect against long-term care, protect against inflation, protect against longevity. But the point is, look at these scenarios here where, a lot of these clients also had a 50-year time horizon where the portfolio is continuing to last. Some of them even touched 40 years. Okay. Look at those. Sure, there are some, these sort of one-offs where the portfolio lasted only 20 years. And part of that is, 1962 or 63, 1968, 1966, right? So, similar scenario as the 4% rule, these portfolios ran into trouble. And instead of lasting 33 years, the portfolio lasted closer to just over 20 years. Okay. But my point is, many times the 5% rule hung up just fine. All right. And then finally, I looked at the 6% rule. This is another illustration, same assumption here, 50% U.S. Treasuries for the remainder. And, even some of these portfolios lasted 50 years. Look at that. 30, that's probably 45 years. That's closer to 50 years. Okay. But you did have some downside here. These portfolios here, that's lasted fewer than 20 years. Fewer than 20 years for all of these portfolios here. Okay, that's not good. I mean, if you retire at 60, you're going to run out of money before your age 80. Okay. And that's why I'm a big fan of this idea of guardrails. Okay. Because you could potentially start with a higher rate of withdrawal up front, knowing that if something happened, if you went through a big bang or a big dipper, is what Bill Bengen referred to in the study, you could potentially back down your rates of withdrawal. And that actually sort of evolved into research done by Guyton and Klinger. And maybe I'll link that in this video as well. But essentially, they really came up with this framework of guardrails and assuming like, okay, if the portfolio does this, you make your spending adjustments by this. In my opinion, that was revolutionary because the 4% rule is kind of that static rate of withdrawal assumption. We know if clients go through significant turmoil or downturns in the market, they're probably going to reduce their spending. You have the flexibility to reduce your spending or change the way you're investing your portfolio or the timing of Social Security. That's another thing, okay, is that the 4% rule doesn't address any Social Security planning. All right. And so that's why I'm gonna break that down in the next video is, a real client example of starting with a different rate of withdrawal and then introducing Social Security at a later date, maximizing that funding that actually helps the plan significantly. But Bill Bengen's 4% rule doesn't assume any other cash flows from anywhere. So if you have Social Security coming in at some point in time, maybe you're retiring at 60, you have Social Security that's going to start at 67 or 70, maybe you could start with a higher rate of withdrawal than 4% or even 5% or even 6%, knowing that you're going to increase those cash flows later on via Social Security and reduce those portfolio withdrawals. Okay, we already addressed this. The asset allocation is very plain vanilla. Okay, and Bill Bengen admitted to this. I mean, he's been interviewed many, many times in the 4% rule, and he's even come out and said, hey, if you add small caps, that small cap stocks, that could increase that safe max withdrawal to 4.7%, let's say. Guyton and Klinger, if you introduce guardrails, maybe you could start with closer to 5 or 5.5 or even 6% rate of withdrawal. But it doesn't assume really a well-diversified asset allocation. So of course that's the downside as well. And then finally, in my opinion, no adjustments. Okay, no adjustments over time. So clients that went through a downturn in 2020 during the pandemic. What happened in 2020? Yeah, the markets fell at the first half of the year by 35%, but most people weren't spending what they normally spend. They're making cuts because they're not taking those big trips that they were taking in the early phase of retirement. So just sort of know that the 4% rule is there as a benchmark. That's why I said it's a benchmark, okay? And when I'm working with clients, we want to figure out what are the goals? Do you want to maximize legacy? Do you want to maximize spending during your lifetime? Do you want to enjoy your go-go years? So maybe spend a little bit more early on and then back down your spending later on. The 4% rule does not accommodate for any of that, okay? And so if we're smart with the timing of Social Security, a well-diversified investment portfolio, and accommodating for potential adjustments, in my professional opinion, you can absolutely start with a much higher rate of withdrawal than 4%. Okay. And again, I'm going to do a video here next with a real life client example where we're doing just that. We're going to maximize spending in their go-go years. We're going to maximize portfolio withdrawals during those years before they take Social Security. And then we'll look at the impact of delaying Social Security to those portfolio withdrawals over time and how that affects the investment portfolio at the end of their plan, so to speak. So that's it for today, everybody, on the 4% rule. I hope you found it helpful. Leave a comment below. Let me know what you think. Do you have questions about the 4% rule? Are you going to use that as a benchmark as you go into retirement in terms of how much you're withdrawing from your portfolio? Oh, and I just reminded one other thing in terms of a downfall or a downside of this, taxes. It does not address taxes. How could I forget? I love reducing taxes for clients in retirement. This does not accommodate for that. So if you have all of your assets in a tax deferred account, okay, the 4% rule that's exactly what it is. It's all in a tax deferred account, 401k or an IRA. If you have assets in a taxable brokerage account, or you have capital gains taxes that are more favorable, if you have assets in a Roth account or an HSA, that also improves your after-tax net rate of return. So all of those things are not factored into the 4% rule. And again, I'm not going to bash on the 4% rule. It's revolutionary advice, revolutionary research that has helped my advice with my practice. But ultimately, I understand the downsides to using it as a rule of thumb for client plans. I understand it's always there as a benchmark, but I'm never going to implement it to the T for most clients that we work with, because we recognize that you're going to probably spend less at the later phase of retirement than you would at the early phase. So why are you spending the same adjusted for inflation throughout? But yeah, hopefully you found it helpful, guys. If you're liking the whiteboard fireside chats, make sure to like the video, make sure to share the video, and make sure to subscribe to the channel. We appreciate that. And we're doing podcasts right now every other week. We've got really some exciting guests on the show over the next couple of weeks. You're not going to want to miss that. And again, the next video I break down is going to be that real life client example on the whiteboard. And so hope you find that valuable. And in the meantime, this is Kevin Lau signing off.